So I'm steamrolling my way into my 30s. I was 32 just 2 weeks ago. And it got me thinking about my 20s and how my 20s went. And in my 20s, I learned an awful lot of stuff. I tried loads of different businesses, I invested, I tried loads of different ways to make money, and I learned a lot of things along the way. And I also made a lot of mistakes. And I thought back to the mistakes I made and thought I'm definitely not going to make the same mistakes in my 30s. And hopefully by sharing some of these mistakes with you, it will save you making some of the same ones I did. And you'll see that even if you do make mistakes, it's all about the journey. It's okay to make mistakes, you can still end up in a really good position. So let's start at the beginning. No, I mean really the beginning. And this is where the first mistake came from. And I think it stems a lot from school and not having the knowledge of knowing how compound interest works and how the whole thing comes together. Luckily, along the way, I found a few friends who were doing it really well, who kind of taught me the ropes. And this mistake was I just didn't really know how it worked, and I didn't understand the power of compound interest and how it built up and how you could make a really big amount of money by starting early. Especially when I was younger, when I was about 16 and 17, savings accounts were fantastic. You could get a cash, tax-free savings account with a rate of 5%, which these days people would kill for. But of course that was linked massively to mortgages, so now it wouldn't have been as good for me. It's no good me getting 5% of my savings if it's coupled with a 10% mortgage rate. But back then I didn't have a mortgage, so I should have really been taking advantage of that 5% rate. It was always something I kind of knew I needed to do, but just never got around to. I thought 5%, what does that really matter? But actually, if I understand that compounded and went up and up and up, then I soon would have started. So I easily missed out on at least 5 years worth of savings in an ISA, and also that ISA allowance, which would have gave me so much more money tax-free. And now talk about starting, my second point is I didn't start a pension early enough. Now I'm in quite a unique situation, and I'm not really in the same situation as a normal person. I've always worked for myself, so I've never had a company to contribute to my pension. So you see these situations where companies are putting 3 times what a company's putting in. I unfortunately am not in that boat, but I am able to save some tax relief, and that's really something I've never taken advantage of. Now you might think that's crazy, I'm 32 and I've not got a pension. I'm about to start one in my new challenge, but up till now I've approached it a bit differently. I've actually just kept all of my money within an ISA, so it's all going to be tax-free by the time I retire. Now there's definitely pros and cons of having a SIP and having an ISA, but for me I wanted to have all of the money tax-free. At the moment the age you can withdraw from a SIP is going to be 57, and I imagine by the time I do retire it's going to be at least 60. So my thought was I'll just build up that pot and I'll have it all tax-free so I can retire whenever I want. Which I don't think is a bad approach, but I think I should have definitely been taking advantage of the tax breaks. And that's mostly because I wasn't in that higher bracket. When you get to the higher bracket it's definitely a clear advantage, but when you're in the basic rate tax it's kind of hit or miss. There's pros and cons to each approach. They're the kind of setup that I should have done earlier. Now let's get into the trading ones. So the first trading mistake that I made was panic selling. Now you might have been in a situation, you've had the fantastic idea to buy a stock, you think it's going to go up and it starts going down. When it starts going down, you panic sell because you haven't gone in with the right intentions. I should have gone in thinking, actually, this is a 3 to 5 year hold. If it goes down, I'm not bothered. But instead, I kind of saw it dipping and I panicked and I sold. Now, the worst case of this was when I bought Bitcoin. I put $10,000 in Bitcoin with the approach that I was just going to leave it 5 or 10 years. The next day, it dropped 20% and I was down $2,000. And I thought, oh my God, I need to sell this. I'm losing all my money, and I ditched it. So I think I ended up in total losing $2,500. When in actual fact, the next week it jumped right up. So my $10,000 would have been worth $18,000 and I could have cashed out. And that wasn't even at the peak. I've also done the same thing where I bought stocks and then have kind of changed my mind last minute. So when you're trading, make sure you're going with a real reason and a plan to hold it long term. If things dip, don't panic. Now the next one that I had to throw in there was FOREX signals. What was that? FOREX signals. Now I had to throw this one in because it's so much fun, but it's pretty much classed as gambling. We've all had the idea, right? Who doesn't want to be a day trader and make a fortune? You can go from having $10 up to $1 million in the space of a week if you could predict the future. Now Forex is extremely addicting. Essentially, you're betting on currency and you're betting that maybe the dollar to the pound is going to go up or down. Now you see the candlesticks moving up and down like crazy, you're kind of taking a best guess on where it's going to go. Now there's a lot of people who say you can predict patterns and all these kind of shapes in the chart which will tell you what's going to happen, but I'm yet to see any of those people make a fortune. Now I started off in a lot of groups where they give you a signal saying to buy this, to sell this, and it worked quite well. Now if you can get a group and the majority of the time they're doing well, then you can make profit. But the problem is once you start making profit, you get greedier and greedier and risking more and more. And when you get to that stage, you can soon lose all your money. Now I've done this for a period of 6 months, had an awful lot of fun, but in the end, I didn't make any money at all. I kind of got to the stage where I was just risking money for fun, and I was just doing it as a gamble and a bit of a laugh. And I was just really gambling with my money. Now the vast majority of these groups make all of their money from getting people to sign up and then making commissions off the back of them. They don't care if you win or lose because they're just making money every single time you place a trade. They boast with the pictures of the Lamborghini and the latest watches, when in fact most of the time it's rented, borrowed or photoshopped. I would like to try Forex again at some point just for fun, but it was really not a good use of money. I could have just saved that money and gotten that compound interest. Now the next mistake I made was copy trading. Copy trading? What's that? Well, copy trading allows you to copy the trades that other traders are making. Now, I used a platform that showed a really impressive win rate, that traders were winning and winning and winning, that they weren't kind of taking any losses and they were just taking small profits and making money along the way. So I was using a system that was allowing you to copy that and make these small profits. Now, what I didn't realize is there was a lot of flaws in the software. They were hiding losses and they were kind of not showing you the full picture. And they were expecting you to risk an awful lot of money on somebody you don't even know. They might have a crazy username like PinkSquirrel64 with a little picture of a squirrel, and they're expecting you to invest an awful lot of money based on that. That platform was probably my biggest loss because I loved the platform and I really wanted it to work. I'll show a full video explaining the whole process, how copy trading worked and how I got scammed, because I think that'll be super interesting. So if you're not already, do subscribe for that one. Moving on to my next point was I didn't understand fees. Now luckily I think platforms have got so much easier with platforms like Free Trade with 0 fees. But depending on what platform you're on, you need to be aware of what fees are and how they work. Now one of the biggest fees that hit me was the FX charge, which is the foreign exchange charge, which is what you pay when you're buying shares overseas. Now on some shares that I bought, particularly silver miners over in the USA, I've paid fees of up to $300 to sell a company. Now it does scale on how much you're buying and selling, but those fees really add up. Just think if you had an extra $300 to invest, how much you're losing. The other fee that can surprisingly really stack up is trading fees. So in the past I bought a share and I've thought, okay, I'm going to invest $5,000 into this share, then I'm going to put an extra $2,000 and an extra $100. Well, actually, I paid the trading fee 3 times instead of just being really aware of what I wanted to buy in the first place and having a clear plan. So I've ended up paying about $40 when I should have paid about $12. The other fees that have hit me in the past is the spread. And this has been quite notorious with Trading 212. Now, sometimes when you go and buy a share, the price you pay isn't the actual price of the share. It's actually inflated so they can make a profit in the middle. Now, what typically happens on a lot of common stocks, it'll all be the same price. But there'll be 1 or 2 you want to buy, and when you think it's all fine and there's no increased spread, actually you are paying an extra fee. Another thing to be aware of, sometimes when you want to sell a share, you're not actually going to be offered the price of the market. So I've gone to sell maybe $10,000 in a particular share because I've seen the market's dropping or it's really high. You go to sell it and there's no one available to buy it, which means you're not able to sell it for the price it's at. So sometimes if a share is really inflated and it's rocketed up, you're not actually going to be able to sell. Now this is quite rare and it doesn't always happen, but it has happened to me on a couple of occasions. And if you're not careful when you accept the trade, you're actually selling it for a much less price. So I've gone and I've sold $20,000 in a particular share and I've got back maybe $18,000 and I'm thinking, where's that $2,000 gone? Well, actually, it's gone because they haven't offered me the price that it actually is, which is virtually daylight robbery. So you need to be aware that sometimes the price you're offered isn't the price it's worth. So you need to double check before you accept the deal. So for my last mistake, boy, I've made a lot of mistakes. Well, this mistake is a bit controversial and it's something that I believe in, which you might think, hold on a minute, is that right? And that is, in my 20s, I didn't take enough risk. Now, there was plenty of companies I loved back in my 20s. There was Netflix, Amazon, Facebook, Apple, all of those big companies that I really wanted to buy. But when I talked to people I knew that were investing, they kind of said, why would you want to buy those? They're so overpriced, they're so overinflated, they're never going to go up, they're going to drop in value. Well, of course, the complete opposite has happened. They've all rocketed up in value and they've done really well. And it's kind of one of those moments where you go,
what the hell is he doing?
Microsoft went down 3 points.
Why didn't people invest in Microsoft? I mean, it was so obvious that that company was going to be so huge. And you think, why didn't I invest in Amazon? It was obvious Amazon was going to be big. Now, there's plenty of arguments against this, why it wouldn't be big, but in actual fact, when you're young, you can afford to take those risks. When you're in your 20s and even when you're in your 30s, if you're not planning on retiring for the next 20 years, you can take risks and buy companies that might go up or might go down. And eventually, more often than not, they're going to end up. As long as, of course, they're a really solid company and you think they've got a lot of potential. For example, I've just bought some shares in Alibaba. They're getting hammered at the moment, but I think in the future, they're going to come back up. And a lot of big investors are getting on board and buying them as well. So while you have time on your side, take advantage, take some risks, start some businesses, try some side hustles and just go for it. So I hope from this you can take some of the worst mistakes that I've made, but actually realise I've still done pretty well. I've had lots of fun trying all these different things, and I'll probably still make some mistakes along the way, but oh well. As long as I learn from those mistakes and don't make the same mistakes again, that's all anyone can ask. Despite making all of these mistakes, I was still able to save over $100,000 twice. If you want to see how I did that, you'll probably want to click this video right here.